Hello friends. The Social Security Administration does not treat everyone the same. Depending on the exact year you were born, your full retirement age is different, your claiming options are different, and the mistakes that can permanently reduce your monthly check are entirely different. And right now, in 2026, people in every relevant group are losing money or making irreversible decisions simply because nobody sat down and explained the rules for their specific case. If you blindly wait for the government to tell you how changes in the law impact your check, you will be too late. Find your group, listen to what applies to you, and by the end of this video, you'll know exactly what to check and what to do about it. Before we get into the groups, if you're not subscribed to this channel, please do that right now and turn on the bell. Here's why it genuinely matters. The rules around Social Security change constantly. Proposed bills turn into law, earnings limits shift, tax brackets adjust, and when they change, the relevant agency does not send you a personal explanation in the mail. They change the policy, update a dense PDF on their website, and expect you to already know. What I do on this channel is take those changes, break them down by what they actually mean for your specific situation, and get that information to you before the deadlines pass and before the mistakes are already made. The gap between finding out in time versus finding out after the fact is the entire reason this channel exists. The people who are subscribed here find out about these things in time. The ones who aren't tend to find out after the wrong claiming decision, after the deadline, after the money is already gone. Hit subscribe, turn on the bell, and let's get into it. Let us begin with the first group. If you were born between 1943 and 1954, you are currently between 72 and 83 years old. Your full retirement age was exactly 66. At this stage in life, most people in this age bracket assume their Social Security decisions are entirely in the rearview mirror, and that their only job is to collect their check. That assumption is costing a massive percentage of you real, spendable money every single month. The first specific area you need to investigate is your survivor benefits, particularly if you are a widow or widower. A shocking number of surviving spouses are currently collecting only their own individual retirement benefit, completely unaware that they could be receiving a substantially higher amount based on their late spouse's earnings record. The survivor benefit allows you to claim up to 100% of what your deceased spouse was receiving. If your own benefit is $1,500 a month, but your late spouse was receiving $2,400, you are legally entitled to step up to that $2,400 figure. But the Social Security Administration does not automatically switch you to the higher payout if you do not formally apply for it. If you are a widow or widower and you have never explicitly asked the SSA to run a side-by-side comparison of both records, you are likely leaving hundreds of dollars on the table. You need to call the SSA directly at 1-800-772-1213. When you get a representative on the line, tell them you want to verify if you are receiving the highest possible benefit across all available records. The second critical issue for this age group revolves around the new 2026 cost of living adjustment and your Medicare Part B premiums. In 2026, the official Social Security COLA is 2.8%. This means the average retired worker will see their monthly check increase from $1,976 to $2,032. That is a boost of roughly $56 a month. But before you spend that money, you have to look at what is happening to your healthcare costs. The standard monthly premium for Medicare Part B enrollees has jumped to $202.90 for 2026. That is an increase of $17.90 from the 2025 premium of $185. Furthermore, the annual deductible for all Medicare Part B beneficiaries is now $283. If you just accept these deductions passively, your 2.8% COLA is immediately eaten by healthcare inflation. But it gets much worse if you are caught in the IRMAA trap. IRMAA stands for the Income-Related Monthly Adjustment Amount. If you sold a house, took a large required minimum distribution from a traditional IRA, or converted funds to a Roth IRA 2 years ago, your modified adjusted gross income spiked. Because Medicare looks at your tax returns from 2 years prior, a one-time financial event in 2024 is dictating your Medicare premiums right now in 2026. The base threshold for 2026 is $109,000 for an individual or $218,000 for a married couple filing jointly. If your income on your 2024 tax return was even $1 over $109,000 as a single filer, you do not pay the standard $202.90. You pay $284.10 every single month. If your income spiked over $137,000, your premium skyrockets to $405.80 a month. If your income has since dropped back down to normal retirement levels, you do not have to just sit there and surrender that money. You must file Form SSA 44, which is the life-changing event form. If you experienced a recognized life-changing event, such as a work stoppage or the death of a spouse, you can petition the government to recalculate your premium based on your current, lower income, rather than that inflated past income. If you are paying anything over the standard Part B base premium of $202.90, you need to investigate your IRMAA status and file that appeal immediately. Now, let us move to the most critical group in the entire system right now. If you were born between 1955 and 1959, you are between 67 and 71 years old. This is the absolute danger zone, because the rules change for every single birth year in this bracket. The government phased out the age 66 retirement age gradually, and most people simply guess their number. If you guess wrong, you take a permanent pay cut. Here is the exact math. If you were born in 1955, your full retirement age is 66 and 2 months. If you were born in 1956, it is 66 and 4 months. Born in 1957, it is 66 and 6 months. Born in 1958, it is 66 and 8 months. And if you were born in 1959, your full retirement age is exactly 66 and 10 months. That is your specific, unchangeable finish line. Why does this matter so much right now? Because people in this group are actively making, or have recently made, their claiming decision. The difference between getting it right and getting it wrong is permanent. If you claimed your benefit at age 62, and your full retirement age was 66 and 10 months, you locked in a permanent reduction of nearly 30%. On a $2,000 base benefit, you permanently surrendered almost $600 every single month. That is $7,200 a year, completely gone forever. If you have not yet claimed, and you are currently past your full retirement age, you are earning delayed retirement credits. Every single month you delay past your specific full retirement age adds 0.2% to your final payout. That equals a guaranteed 8% annual return on your money, maxing out at age 70. Do not wait past age 70, because the credits stop completely, and you are just giving the government free money by delaying any longer. Additionally, if you are in this birth year group, and you decided to claim early but you are still working a job, you are trapped in the earnings test. This is where the SSA claws back your benefits if you make too much money. In 2026, the annual earnings limit before you reach full retirement age is exactly $24,480. If you earn a W-2 income above that exact threshold, the Social Security Administration will penalize you by withholding $1 for every $2 you earn over the limit. Let's say you claim early and you earn $34,480 at your job this year. That is $10,000 over the limit. The SSA will hold back $5,000 of your benefits. They don't technically steal it forever, they recalculate your benefit at full retirement age to slowly pay it back, but in the short term, your checks simply stop arriving. The rule changes slightly in the actual calendar year you reach your full retirement age. For 2026, if you hit your specific full retirement age at some point this year, the earnings cap jumps to $65,160. And the penalty softens. They only deduct $1 from your benefits for each $3 you earn over $65,160, and this only applies up until the actual month you reach full retirement age. Once you cross your birthday month and hit your FRA, there is no earnings limit whatsoever. Your work income has no effect on your benefits from that point forward. If you are working and claiming early, you must track your gross wages down to the penny and report your estimated earnings to the SSA. Otherwise they will overpay you and demand the money back in a lump sum later. Our third group includes anyone born between 1960 and 1965. You are currently between 61 and 66 years old. For every single person in this bracket, the government has simplified the math, but they have made the penalty far harsher. Your full retirement age is exactly 67. The single most important reality you must accept right now is the catastrophic penalty for claiming at age 62. If you claim at 62, your monthly check is slashed by exactly 30%, permanently. If your full benefit at 67 is supposed to be $2,500, claiming at 62 drops that number to $1,750. You lose $750 every single month for the rest of your natural life. If you live to age 85, that early claiming decision costs you over $200,000 in lifetime wealth. The Social Security Administration will gladly process your application at 62. They will not give you financial advice. They will not warn you about the compound interest you are sacrificing. You will check a box, sign the form, and seal your financial fate. There is another critical trap for this specific group that almost nobody talks about until it's too late. If you retire and claim Social Security at 62, Medicare does not kick in until age 65. That leaves you with a 36-month gap where you must purchase private health insurance on the open market. A decent silver tier plan for a 62-year-old can easily cost $800 to $1,200 a month. If your reduced Social Security check is $1,750 and your health insurance premium is $1,000, you are left with $750 a month to pay your mortgage, buy groceries, pay property taxes, and cover utilities. It is mathematical suicide. Before you even think about claiming early, you must solve the healthcare gap. You need to price out your premiums on the health insurance exchange and subtract that number directly from your age 62 benefit estimate. If the math doesn't work, you cannot afford to claim early. If you are in this group and you choose to wait, you unlock a hidden tool called the retroactive lump sum. If you apply after you reach your full retirement age of 67, you can ask the SSA to backdate your application up to 6 months. They will literally hand you a check for 6 months of retroactive payments. If your benefit is $2,500, that is a one-time cash injection of $15,000. Your ongoing monthly check will be slightly lower because they adjust your starting age back by 6 months, but it is a massive tool for wiping out high-interest debt, paying off a lingering auto loan, or funding a cash emergency reserve immediately upon retirement. The option exists, it is completely legal, and almost nobody asks for it because the SSA does not advertise it on the front page of their website. Our final group comprises everyone born in 1966 or later. You are 60 years old or younger. You are not on the verge of claiming, and that is your biggest advantage. You have time, but that window is closing faster than you think. Your full retirement age is 67. Claiming at 62 will result in that same 30% permanent reduction, and delaying to 70 will result in a 24% permanent increase above your baseline. Those percentages are written in stone. What is not written in stone is the accuracy of your lifetime earnings record. Social Security calculates your future benefit using your 35 highest earning years. They index those past wages for inflation, average them out, and apply a complex formula to determine your final check. But that entire calculation relies on flawless data entry over a 4-decade period. Every single time you switched jobs, every time a company was acquired, every time an HR department manually keyed in a W-2, there was an opportunity for human error. A single zero dropped from your 1998 W-2 can permanently cripple your future payout. If a $60,000 year was accidentally reported as a $6,000 year, and you do not catch it, that error stays on your record forever. Each missed or wildly incorrect year can reduce your future monthly check by approximately $50 to $100. If you have 3 errors spanning different decades, you could be bleeding $300 a month in retirement, entirely by accident. You also need to understand how the system taxes your current income. In 2026, the taxable wage base limit has increased to $184,500. That means you pay the 6.2% Social Security tax on every dollar you earn up to $184,500. If you make $200,000, you pay nothing into Social Security on those last $15,500. This number shifts every year, and it dictates exactly how much of your paycheck vanishes before you even see it. You must fix any historical errors on your record right now, because the government requires hard proof to change the math. You need the original W-2, the pay stubs, or the tax returns from the year in question. Finding a tax return from 1994 is incredibly difficult today. Finding it 10 or 15 years from now when you finally decide to claim will be literally impossible. You need to go to ssa.gov today. Create your My Social Security account. Download your official statement and pull up the exact year-by-year earnings grid. Line it up with your historical tax records. If you spot a blank year where you know you worked full-time, or a number that is drastically lower than your real salary, you must act. You need to fill out Form SSA 7008, which is the request for correction of earnings record. Attach your proof, submit it to the administration, and force them to correct the math while you still have the paperwork and while the fix is completely free. So, here is the summary by group. If you were born between 1943 and 1954, check whether you are on the highest possible survivor benefit record, and aggressively appeal any Medicare IRMAA surcharges using Form SSA 44 if your income has dropped below the 2026 thresholds. If you were born between 1955 and 1959, memorize your exact full retirement age down to the specific month, and meticulously track your W-2 wages against the $24,480 limit if you are claiming early and still working. If you were born between 1960 and 1965, fully calculate the devastating 30% permanent penalty of claiming at 62, and lock in your healthcare strategy to cover the 3-year gap before you pull the trigger. And if you were born in 1966 or later, log into ssa.gov today and audit your 35-year earnings record while you still possess the physical documentation to demand a correction.